Welcome to Wealth Coffee Chats, folks, for your daily live updates. Get the most out of today's episode by participating in the chat. Make sure you ask some questions, be part of the conversation, have a bit of fun, grab a coffee or a tea, take some notes, and get ready to start your day, folks. Quick few housekeeping rules, though. No spamming, no advertising or self-promotion in the chat. That's not on. Be kind and respectful to everyone when participating. And most of all, have a good time. Real estate investing can be your biggest asset. It also can be your most expensive asset when it comes to getting it right or getting it wrong, folks. It can be time-consuming, stressful, and that's why here at Positive, we have what's called a 6-star team, a full-service team that provides integrated wealth and property investing solutions and services simply designed to help you progress towards your goal of passive income through your property portfolio, folks. Make sure you check out our other podcasts on the Positive Mentor Network. Not only is there Wealth Coffee Chats, there's the Urban Property Investor. Drops every Wednesday with straight talking investing strategies and lessons with Sam Saggers. Property Investor Tales. This is where our clients, you guys, share real life stories from property investing, hosted by some of our advisors and strategists. And that's done every fortnight, dropping every Monday. Wealth, Wine and Wisdom, folks, that debriefs the week that was in the world of finance and property, hosted by yours truly, Jason Witten and Andy Fenton on Fridays. Hey, good morning, folks.
Good morning, everybody. Welcome to another Wealth Coffee Chat.
Hope you're well, folks, wherever you are.
There it is, team. Morning. Morning, wherever you're tuning in from today.
Early bird gets the worm, they say. Here at Positive, we offer a 6-star team. It's a team that help you at every stage of your wealth creation journey.
Good morning, everyone. Welcome back for another Wealth Coffee Chats. It's Tax Tuesday. I'm Daniel McPherson from Positive Tax Solutions. Cooling off around the country, it seems. Pretty cool here this morning, so that can only mean one thing too. So that means we're coming up to June 30. So today we're talking about tax planning before June 30. And trust me, this time of year is where good planning can literally mean thousands of dollars in tax saved. Now, I know tax planning doesn't sound exciting to most people, but the truth is, if you're a business owner, investor, or high income earner, this is one of the highest value conversations you're going to have all year. Because after June 30, your options start to vanish. Tax returns become historical reporting, but right now you're in the driver's seat. You can take action. So let's talk about what you can do right now to take control and save real money. Most people think tax is once a year, usually when their accountant says it's time to lodge your return, but by then it's too late to change the outcome. So the time to take action is before 30th of June, and here's why. Because tax isn't about just reporting, it's about a strategy. So a single phone call before 30 June can save you up to 5, 10, even more, 5, 10, 15,000, even more depending on your circumstances. And often it's not even about complicated loopholes. It's just about timing and knowing the rules. So the ATO really isn't out to get you, but they are out to make sure that you're paying what you owe, or even more if you don't know the rules. And if you're not planning, you're probably overpaying. So let's break it down into sort of 3 categories of people we're speaking to today. So we've got business owners, investors, and individuals who are on PAYG who want to maximize deductions and contributions. So first up, we'll dive into business owners. So if your business is a small business under 50 mil turnover, and you're on cash or a simplified accrual basis of reporting, you can prepay expenses and claim them this year, even though the benefits are for next year. So think about things like rent, insurance, loans with fixed interest periods, software, IT subscriptions, memberships, team training programs. So if you say pay $12,000 in rent for the next 12 months, that's $12,000 you get to deduct this year, dropping your taxable income straight away. So something to keep in mind there. And the next one is to review debtors and bad debts. Do you have any unpaid invoices that you just know are never getting paid? So before 30 June, review your debtors. If you have any income that was previously included, but it's now recoverable, unrecoverable, I should say, you can write it off as a bad debt and claim a deduction for it. So there are a few rules around that. You must have previously included in assessable income, and you must have done, I guess, pretty much all you can do to try and get the debt in. So do those couple of things, then write it off before 30th of June, because writing it off in July is going to be too late. Now, the third one is paying superannuation. And this is one of the most powerful deductions and most often overlooked for business owners, because you can only claim super once it's received by the fund, not the date you process it. So it's the date that it clears. So if you want the deduction for this year, so for you, for your staff, for the June quarter super, you need to pay it early. Use a clearinghouse with fast processing. One option is to use the ATO Small Business Clearinghouse, because with the dates you kind of get a bit of an advantage where as long as it's paid to the clearinghouse before 30 June, you can claim it as a deduction. But really aim to have the funds cleared by the 24th to the 26th of June, just to give yourself a few days grace. And if you've got strong cash flow, consider prepaying July super to lock in the deduction now as well. But make sure you're within caps, especially for related parties like directors as well. And the next one is the instant asset write-off. So this one's a bit tricky right now. The temporary full expensing measures ended on 30 June 2023. So that was pretty much you could write off any asset of any value. So we've got a $20,000 instant asset write-off continuing for this current financial year. So just don't assume that you can write off a $30,000 ute or a big piece of machinery. Check with your accountant first. So you need to determine whether it falls under the depreciation rules or the immediate deduction. If it's under the small business depreciation rules as a small business pool, it's 15% in the first year and then 30% each year after that. So it's definitely not as good as having the immediate write-off. So just make sure you check which category the asset's going to fall into. Now, the next one is reviewing stock. So if you carry inventory or materials, make sure you do a stock take before 30th of June. If the stock's dropped in value, you might be able to write it down to its current market value and deduct the loss. And also to get rid of all that stock that's obsolete, or maybe you've got some spoilage that you can get rid of and get the tax deduction for. So that's really important. Each year, always make sure you do your stock take prior to 30 June. And the next one is a bit of a hit list on the ATO at the moment. But if you've got a discretionary trust, every year you need to resolve who's going to get the income before 30 June. And if you don't, the consequences are pretty severe. The income can be taxed at 47%, and you can't adjust that later. So it must be in writing. And the ATO are kind of cracking down on a couple of different sections in the tax legislation. So Section 100A and a couple of other integrity rules. So make sure you get advice and get it documented properly, because, again, as is always with tax, the onus is on you to show and prove that you made that resolution prior to the 30th of June. Cool. So there are a couple of big things for business owners to look at. But for the property and investment people, we've got interest and deduction prepayment. So if you've got an investment property or a fixed interest loan, you can potentially prepay up to 12 months worth of interest and claim it this year. So that's worth checking with your bank. We'll let you do that. Also look at potentially prepaying property management fees, body corp levies, bring forward any maintenance and repairs that you can. And just keep a note though for repairs, although repairs are deductible, any improvements are not. So if you're upgrading sort of like the bathroom, that's a capital improvement. They're going to be depreciated over time. But if you're painting over mold and just fixing it up, then that's a repair. So the ATO are really targeting this year, so make sure that you get it correctly classified. Now, the next one is depreciation reports. If you haven't got a depreciation schedule for your rental property, then get one before 30 June. It's a one-off cost. You can save, or you can create thousands in deductions every year, particularly for newer builds. And yes, the cost itself is also tax deductible. So make sure you get your depreciation reports done. make sure if you are then adding any additional improvements, whether that be appliances or doing renovations, either get them included within your depreciation report, go back to the quantity surveyor, or make sure that information is with the accountant to make sure that that's included. Next one is any capital gains and losses. Did you sell an asset this year and make a gain? Good time to review your portfolio. If you've got underperforming assets that you were thinking about sort of selling them prior to 30 June to realise capital loss might be beneficial. So I guess review if you're going to sell. If you're going to sell, make sure you've possibly hit the 12-month mark because after 30 June, you lose then the 50% discount. So if you don't hold it for more than 12 months, that 50% discount's gone. Now, for individuals and employees, we've got maximising super contributions. So the concessional cap for this year is 30,000. So this is inclusive of your employer contributions, salary sacrifice, and personal contributions. So you can top up your super before 30 June and claim a personal deduction. Again, although personal deductions aren't going through a clearinghouse, for whatever reason, they still seem to take a long time to process. So make sure you find out what the last date that you can make the contribution to your super fund is for when they're going to accept it. So just check that you're not going to exceed your cap. You can jump onto the ATO portal through MyGov. You can see what your current contributions are. I guess just keep in mind that your employer might be paying your contributions just prior to 30 June as well. So maybe just ask them to find out. And the other thing that you need to keep in mind that you need to do is you need to lodge a notice of intent to claim that contribution as a tax deduction with the super fund before you do your return. So that's a big one. And for those who have a total super balance of under 500,000, you can carry forward the unused concessional cap from the past 5 years. So this is pretty powerful for those who might have an irregular income, business owners who haven't contributed in prior years, or you've got potentially maybe a big capital gain this year that you're trying to offset. So I guess like you could claim $50,000 or more in a single year and claim it all. So that would be really effective in some of those scenarios. And the next one is making sure you maximize your work-related deductions. Common deductions are like tools and equipment, union fees, subscriptions, so like professional memberships, any training that's directly related to your job and earning your income. But also remember, you need your records. You need a genuine link to your income. And the ATO is kind of cracking down at the moment on copy-paste deductions. So if you're just copying what you did last year, there's a good chance that their systems are gonna flag that, and then they may be asking questions about that. And for home office, some new rules around that. You're actually going to need pretty much like a diary or something to show how many hours you worked actually through the full year. So no longer can do sort of like a month's representative diary. It has to be what you actually worked for the full year. And then if you do have actual expenses that you're going to claim, you need proof of those. So receipts and invoices, definitely need to keep those. Now, I guess a few quick wins and some final ones is make sure you make any donations that you're going to do prior to 30 June. It must go to a registered deductible gift recipient. So make sure you check whether you're donating to is one of those. Keep the receipt because you need that for the deduction. So make sure you keep that and then a win-win. So they get a gain and so do you. And the next one is private health. So if your income is about above 186 for couples, 93 odd for singles, and you don't have hospital cover, you may be hit with the Medicare levy surcharge, so up to 1.5%. In saying that, although now you're only going to get a very small portion of time that's going to be within this current financial year, it'll help you for next year just to save on that Medicare levy surcharge that you might be hit with. So definitely have a look. Sometimes you can be in a bit of the grey zone where the additional cost of the health insurance is maybe more than the levy, but do make sure you get a quote and make sure you compare. And I guess end of financial year planning isn't just about tax, it's about strategy. So Are your structures still working for you? Do a review. Is your trust, if you've got one, compliant? Make sure you've got those resolutions in place. And is your business geared for scale or chaos? So every year, people are leaving tens of thousands of dollars on the table by waiting until after 30 June to have a look. So we've covered off a fair bit today, but I guess the key takeaways are tax planning is proactive, not reactive. So don't wait until after 30 June. You've still got some time to act. And the best time to review your tax strategy is now. So hopefully you got something from that. Thanks very much, guys. That's another Wealth Coffee Chat, and we'll talk to you again soon. See ya.
General advice disclaimer. The information provided and made available through this podcast does not constitute financial advice. The information is of a general nature only and does not take into account your individual objectives, a financial situation, or needs. It should not be used, relied upon, or treated as a substitute for specific professional advice. We recommend that you obtain your own independent professional advice before making any decision in relation to your particular requirements or circumstances. Positive Tax Solutions and its representatives do not warrant the accuracy, completeness, or currency of the information provided on and made available through this podcast.
Thanks for watching another episode of Wealth Coffee Chat, folks. Make sure you like, subscribe, and turn on your notifications so you never miss a thing when we go live. Improve your portfolio and investing game, folks, with Wealth Coffee Chats live every morning at 8:10 each weekday. Make sure you join us. Previous episodes are also available wherever you get your podcasts, folks, as well as our other podcasts from the 6-Star team here at positivementor.com.au.